if you don't renew your insurance with us, we'd love a chance to be able to talk with you or answer any questions you have. I'm going to talk about replant late plant real quick, and then Waylon's going to go over what happens if you can't plant your preventive. Okay. Replant is available if you have a revenue protection policy or yield protection policy. To qualify for replant, it has to be the lesser of 20 acres or 20% of the unit. For example, you have an 80-acre field, you need to have the lesser of 20% or 20 acres, so 20% of 80 is 16 acres to qualify for replant. To qualify, you must have planted the crop on or after the initial planting period. For corn, that's 4/11, I believe 4/11, and then 4/21 for beans.
Yeah, April 11th for corn is the initial plant, and April 21st is the for beans.
Unless you want to respond.
No.
And only 90% or less of a unit will qualify for replant. And then also acres will be considered practical to replant inside of the 10-day after the final planting date, which we'll go over here shortly. The payment is made as 8 bushels on corn and 3 bushels on beans. And so to figure that, the 8 bushels times your acres that qualify for replant, times the projected price, times your share. Projected price is 4 on corn and then $9.54 on beans. And you can only have one replant made on the acres in the same year. So here's an example of how that's paid out. Joe Farmer submits a notice of loss for corn replant. The adjuster releases 40 acres of corn for replanting on a unit with 100% share. The projected price is $4, and that was the spring price. So to figure the math on it, you take your 8 bushels, it's written into your policy, times 40 acres that were released by the adjuster, times the $4 price, times 100% share, and then it gets you $1,280 indemnity for your replant. So there's a late planting period for corn. May 31st is the last day to plant your corn. After that, it's 25 days. After that, we enter the late planting period. And so what that means is your guarantees are reduced by 1% per day when you plant into that window after May 31st. For soybeans, June 15th is the last day to get your soybeans in. And then after that, your liability starts being reduced 1% per day after the 15th of June. End of late planting period after you added those 25 days is June 25th on corn and July 10th on beans. Okay. If the corn could not be planted after the late planting period, so 25 days from the last of May, so June 25th, you can't get your corn in, what happens is the preventative planting guarantees apply. If you do a buy-up coverage, if you elected to buy up 5% of your prevent plant, that goes into effect. You also have the option to not insure the acreage after the late planting period. So there's a couple advantages and then some disadvantages to consider when you're deciding if you want to insure or not insure after the late planting period. So one advantage is the crop has coverage on the acres if you go ahead and insure it, even though the reduced preventive planting guarantee. So you'd have your coverage reduced because it wasn't in on time. But your APH might suffer because you're getting it in the bushel potential isn't there, yield potential isn't there, and you also are charged full premium. That's not reduced. If you don't want to insure the acres, there's a couple good things or a couple bad things that might happen. You don't have to pay premium because you don't have coverage, and it won't affect your APH on that unit. But if there is a claim, you won't get a payment because there's not coverage on those late planted acres. So all timely planted acres should be reported separately from late planted acres. All acres planted after late planting period must be reported separately. And this is because we want to get the right guarantee covered. So if you got acres in on time, we want those covered at the higher guarantee and not reduced. So here's an example of how the guarantee would work out. So Joe Farmer has 100 acre corn on a unit with 100% interest and 180 bushel APH. He chooses 80% coverage at a $4 price. That was the spring price again. And he plants 50 acres on May 15th, so those 50 acres are timely planted, and finishes the farm on June 10th. So 50 acres timely planted, 50 acres are not. The final planting date is 5/31 for corn, and the late planting period is for 25 days. So the 50 acres that were in on time on May 15th, to figure his guarantee, you take his yield of 180 times his election, so 80%, times the $4 projected price, times his share, and you get $576 an acre, and multiply it by 50 acres and get 28,800 covered on those 58 acres. Now the 50 acres that were planted on June 10th have a penalty, a 10% penalty, because they were 10% later than the final planting date of 5/31. So the 50 acres, if you figured, was 576, do the math. You take 10% of that, so 576 times 90%, because you're losing 10% of your guarantee by having them late planted, and you get $518 of coverage versus the 576. You multiply that out by 50 acres, and so we're looking at 28,800 for the time planted acres versus 25,920 for your guarantee. And then you add those up, 54,720.
All right, so this is just a quick definition of what preventive planning is considered in the policy provisions. Won't really go into it, it's just the language in the policy. So preventive planning coverage is available on all revenue and yield policies. There's a standard provision in the policy that states you have coverage for 55% of your federal crop guarantee on corn and 60% on soybeans. We do have the 5% buy-up election available, and we can do that on any revenue and yield policy. Should be available in most counties in the area here. I'm not aware of any that don't have that. So with the additional coverage election, it must be elected by sales closing date, and we do a 5% option. It's called PF option. Adds 5% to your coverage guarantee. So you'd end up at 60% on your corn and 65% on soybeans. The option stays on your policy until you elect to take it off. And the company reserves the right to individually review if you're electing that option in any given year to determine if there's conditions existing. You know, for example, this spring we had several people try to take the option in northwest Missouri. They got denied because of the flooding on the Missouri River and because it was so wet this spring. So there's always the risk and possibility that the company will say, no, we're not going to allow that to happen. For the insurance period, for any new policyholders or your first year in coverage, the insurance period begins the day following sales closing date, so generally March 16th. For carryover and continuous policyholders, it begins on the sales closing. And then it ends on a calendar date for the insurance period, which would be December 10th, or the date your preventive plan coverage is finalized. For notice of loss, you're required to provide a notice of loss to the company within 72 hours after the final plant date if you don't intend to plant through into the late planting period, or no later than the end of the late planting period. So we can't take a preventive plant claim today, however, tomorrow we could. and then we can take those all the way through the late planting period up until 3 days after the fact. So in discussions with several folks in the last few weeks, I've encouraged if you have any doubt whatsoever, let's go ahead and get it turned in, because the worst thing that could happen is we just withdraw it if you can get those acres planted. For acreage reporting, much like with the late planted acres, we need to have those acres split off from your timely planted stuff. And if you've got a unit where you were able to plant some but not other acres, the acres reporting deadline is the same as with your timely planted stuff, so July 15th. And reporting prevented plant acres on your acreage report is not considered a submission of notice of loss. So we do need to take that in separately. For eligible acres, the acres must be insurable. Uninsurable acreage that has not been planted or harvested in one of the 3 most recent crop years, unless you've got a crop rotation allowance, for example, alfalfa, it's considered an insurable crop, so it's going to be excluded from that provision. Land that was not planted to comply with the USDA program, such as CRP, wetlands, etc. The land must be available and available for planting, trees, rocky outcroppings, all that. So if you've got a few acres of trees that you're planning on taking out but hadn't gotten to, we're not going to be able to do a prevent plant on those acres. It's going to be determined separately by crop and county, and we must qualify. 2020 rule is kind of the standard for that. You got to have 20 acres or 20% of the unit. So if you're on enterprise units, you could have 4 acres in 5 different fields qualify. Otherwise, if you're on optional units, it would have to be 20 acres of that particular farm. Total eligible acres of the crop cannot exceed total crop land acres for your operation for the current crop year. And then your total eligible acres is going to be reduced by the number of acres that you were timely and late planted. So anything that's planted is going to come off of eligible acres before we determine what's left and available for prevent plant. Uninsured and second crop acres are also considered part of the planted acres. So we've had situations in the past where that's come into play and knocked folks out of qualifying for preventive plant because they actually had some first crop corn that flooded out, then they planted second crop uninsured soybeans, and so that lowered their number of eligible acres that would qualify and knocked them out of a preventive plant payment on sale. So the base preventive plant acres for a crop cannot exceed the maximum number of acres planted to the crop in the most recent 4 years. So if we were to look at your APH databases and add up all the acres of corn in the most recent 4 years that you planted corn, we couldn't have more preventive plant acres and planted acres than what you've had historically. Unless there's added land, there's a factor that's involved there. If you've got a new farm this year, there is a provision that allows for added land to be included in that. And we'll get into that here shortly. If base acres are exceeded for corn, we can always roll those acres over to beans, but they're only going to pay at the bean rate rather than the corn. It used to be that you could get the corn rate, but they changed the, RMA changed the policy on that, and so, yeah, we're limited to what the like crop payment would be. So this one, Jasper County falls right on the line of the prairie pothole region. You get into Marion County or Mahaska County and you're not in that anymore. However, in this particular situation, this language applies to the entire state. And what this means, what this slide is all about, is for any acres coming out of CRP, and it seems like we've dealt with a lot of that this year, any acres coming out of CRP are not going to be eligible for preventive plant. So we got the specific policy language there. I won't go into too much detail, but just wanted to make sure that everybody's aware of that in case you do have some acres coming out this year that you're hoping to plant. For the enterprise unit qualification, only planted acres you use to qualify for your enterprise unit. So if you've got 2 farms and 2 sections that are going to corn, and you're only able to plant one of them, it's not going to qualify for enterprise units because you've only planted acres on the one farm. When determining your enterprise unit discount, so it's the discounts range by the number of acres planted. So you get X number of percent enterprise discount if you've got 200 acres in the ground. Then it goes up if you get 500. Then it goes up if you get 900, I think. So only the planted acres are going to be considered there. But prevented plant acres are considered part of the total enterprise unit. So here's just a quick example, very simple. Joe Farmer's got 40 acres of corn in section 1 and 40 acres of corn in section 2 and would like to qualify for enterprise. He's also got 18 of those acres that claim prevented plant. Will he qualify for both prevented and enterprise units? Yes. And so we've got 80 total acres on the unit, and so his 2020 qualification is going to be based off of the planted acres. So we had 62 planted acres times 20%, so that's 12.4. So he's got to have at least 12.4 acres in each section in order to qualify there. And for the total prevented plant qualification, we're going to use the total acres. And so 20%, 80 is 16. He falls above that with his 18 that he claimed prevented on. So he's in good shape. And so Joe qualifies for his prevented plant, as we looked at on the last slide, and he qualifies for his enterprise unit as well, regardless of how the 50 acres are split between the 2 fields. And just got a couple quick examples there. So in section 1, he got everything planted. In section 2, he had 22 acres planted and 18 prevented. And then the second example, he had 30 and 32 acres and a few prevented acres in both fields. So overall, that situation, he would qualify on both counts. So here's the added land portion. So if you, and we've got an example down here. So we've got a factor, and what that's going to be based off of is the total cropland acres for this year. And then that's going to be divided by, or multiplied by, the total cropland acres farmed the previous year. So if Joe Farmer had 1,000 acres cropland last year, and he picks up an additional 200, he's got a new eligible acres total of PP for 1,200. And so what we do is we take this year's eligible divided by last year's, and then we get a 1.2 factor, multiply that by last year's to get to 1,200. So let's see, not eligible for payment. Prevented plant is not going to be payable on the following situations. So for example, if the 2020 rule is not met, so if you didn't hit the 20 acres, 20% of the unit, any crop planted during the late planting period or before the final plant date would not qualify unless double cropping requirements are met. That's not something we have to worry about in this area because we don't have any double cropping as an insurable practice. If you planted a crop to an approved cover crop during the final or late planting period or before the final plant date, they're going to deny you coverage on prevented because they're going to say, well, if the conditions were good enough to be out there planting a cover crop, the conditions surely were good enough to plant your intended. And let's see, any volunteer or cover crops are hay grazed or harvested during the late planting period or before the final plant date. Again, they don't want to see any sort of additional economic benefit from any of these acres. So their RMA is going to say, well, you know, you were able to make something off of it, so we're going to say, no, sorry, we can't pay preventive plant on that. And then any acres in excess of your total maximum eligible. So like the situation I spoke about a minute ago where the guy had first crop corn in the ground, second crop beans, and then had some prevented acres as well, put him over the top on his maximum eligible, so he wasn't able to get paid on those.
Question. Quick,
Yeah.
we want to back up to that double cropping. There's a fair amount of people that rye for silage and plant beans afterwards. Is that going to qualify for preventive plant if they can't eat beans?
That's all going to be, I'm gonna have to get back to you on that. Jessica, would you mind writing that down for me, please? But I think that's gonna fall under your cover crop guidelines for the spring. And as far as the chopping goes, I know you're able to go in and hay, but I'm not so sure about the chopping portion of that. And then it would also fall under your timelines for cover crop termination prior to planting. So there's a couple of things we'd have to look at on that. So we'll certainly get back to you on that and let you know. Anything else quick? So we've also got some APH consequences that are involved. So if we've got PP acres where the insured receive full payment, those will not be included on your APH. So if you take a preventive plan on your corn or your beans and just let it ride, maybe you do a cover crop or you just do a chemical spray down throughout the summer, or if you go out just every once and again for weed control, you're going to be fine. There's going to be no APH consequences, no payment consequences, anything along those lines. However, when we've got a second crop planted after preventive plant and the acreage doesn't qualify for double cropping, there is a yield plugged in for those prevented acres, and that's going to be based off of 60% of your approved yield for the unit. So if you had a 200 bushel average, they're going to plug in 120 bushel for that farm for the entirety of the APH database. So that's certainly something you'll want to take into account when looking at plan and prevent plant, for example, on corn, and then looking at planting beans on that same acreage after the fact. And this is also going to be the situation anytime prevent plant payments are reduced. And so here are some of the options when considering going to a second crop after taking preventive on your first crop. And generally we're looking at this from a corn perspective, so if I start rattling on and mentioning corn first, it's just speaking in general terms. So your first option is to not plant a second crop. You're going to be fine there, and you'll collect 100% of your preventive plant payment, no consequences to your APH. If you plant and not insure a second crop, your preventive plant payment and premium are going to be reduced to 35% of what you normally would have gotten. So if your preventive plant guarantee was $300, for example, you're going to get paid it'd be like $103 or somewhere in that neighborhood. And then your premium, if it was 21 bucks an acre, would go down to somewhere in the neighborhood of 7. And then also you could plant and insure a second crop. Again, your preventive plant payment and premium are reduced to 35%, and you're going to be responsible for 100% of the premium on your second crop, and then receive 100% of the payment for any loss on that second crop. So here's just a quick example of how the guarantees are calculated. It's 55% of the unit guarantee for corn. So we've got 150 bushel APH, 85% coverage level. That's going to take you down to your normal federal crop guarantee of 127.5. Then we have to reduce that by 55% to get you to 7.1. And then take that times your spring price and your share to determine what that guarantee will be. Buy-up options will adjust the guarantee to 60% if you elect that option. Preventive plant payments used to be based on the higher of the spring or fall price, but they changed the rules several years ago, so that's based only on the spring price now. And so that example is based on corn. Soybean calculation is identical, except we use 60% as a base and 65% if you were to elect the buy-up option. For payment limitations, you'll receive 100% of the preventive plant payment if the land remains idle or fallow for the remainder of the crop year. And as long as a volunteer cover crop is not hayed or grazed before the 1st of November or harvested at any time. So you could go out and bale that post November 1 and use that hay for feed. But if you were to go out there and mechanically harvest for grain, they're going to reduce your payment on that. Double cropping is an insurable practice for the crop county. You would get the 100%, but again, double cropping isn't generally an insurable practice in Iowa. So, for limitations, preventive plant payments will be reduced to 35% of the total in the following situations: if a second crop is planted for harvest after the first insured crop's late planting period, volunteer cover crop is hayed or grazed prior to November 1st or harvested at any time, or if, for example, you have a farm that you're cash renting or own for that matter, and you sublet or cash rent that to someone else for any agricultural use. And in those situations, anytime your payment is reduced, your premium will be reduced as well. And so here's just a quick example on the eligible PP acres. So we've got a Joe producer who's farming 1,100 acres total, corn, soybeans, and wheat. And we've got his planted acres in the next slide reported by crops for the most 4 recent years. I kind of touched on this a little while ago. So we're going to find out what his maximum eligible acres are by crop, and also we're going to look at an added land scenario here and how that will affect what his eligible acres are. So in year 1, we've got, year 1 we've got 550 acres corn and 50 acres of preventive plant, 325 acres of beans, 75 of preventive plant. Wheat all the way through, he just does 100 acres in rotation. And so you can see the numbers there: 650, 625, 700, and so on. So Joe's year 4 corn at 700 acres, year 1 soybeans at 400, and in a year in wheat, those are going to be his maximum eligible acres because those were the highest number of planted acres of the crop he had in the 4 most recent years. And so when we look at him adding 300 acres for this year, it's going to raise those maximum eligible acres up to 891, 509, 127. And so the formula comes out to 1,400 acres for this year based off of the 1,100 in his cropland prior. So we get a 1.273 factor and apply that to his highest maximum eligible. And so how many acres will be paid in the scenario that I'll be coming up with here shortly, and how will they be paid? So we've got the maximum eligible acres there on the left, and we've got the planted acres total in the middle, and then what he's got for preventive. So he's got 50 acres of preventive on corn, 50 on beans. So let's see how that pays out. So it's all going to pay because he's well under any of his maximum eligible acres. The 50 acres of corn will be paid in full at the corn rate because his maximum eligible on corn is 891. And so he had 725 planted, so he's got 166 acres eligible. So 166 is greater than 50, so he's in no trouble there. On the soybeans, however, we've got a situation where he's going to hit that maximum eligible acre mark. So he's at 509.2. He was a little heavy on soybeans for this year. So he's got 34.2 that he's going to be paid at his soybean rate. And then the remaining 15.8 acres are going to roll to his wheat policy, or his wheat acres, because that's going to be the most likely crop as far as payment goes. And so here's just a quick example running through the numbers of how that's going to pay out at 180 acres on corn, 55 on beans, and 70 on wheat. So he's going to get paid $15,840 on the corn, $8,600 and change on the beans, and $3,037 on the wheat. Okay, so in this situation, what Joe's going to do is he wants to plant some soybeans on the acres that were claimed as preventive plant corn. How will this affect his payment and the policy? So what he's going to do is he's going to receive $5,500 of his corn payment because they're going to reduce that down to 35%. Also, his premium will be reduced as well. He'll receive an assigned yield of 108, which is 60% of his APH for that farm, for the 50 PP acres, and that's going to be in the database for the 10 years that it would be in the rotation. So on those soybean second crop prevented soybean acres, Joe will have the option to insure or not insure those. If he does insure, again, it's going to be at 100% of the soybean premium, and he will be eligible for any applicable indemnity that would come from it. So here's just a couple of quick scenarios on the first crop, second crop. This would be assuming that you got your first crop planted and it failed and you went to a second crop. So we've got three available options. First is you take it to harvest and see how things turn out. Second option would be plant a second crop on the failed acres, waive insurance, and then the third option is to plant a second crop and elect to insure those acres. So on option one, take the acres to harvest. This would be the most likely option if you just got maybe a few drown-out spots in a field, a few acres here or there. If total unit production falls under guarantee at that point, loss would be paid. The adjuster would appraise the acres and assign whatever he determines through his means for a yield for those failed acres. Generally, it's going to be zero when considering a drown out, especially this early on. But sometimes they do assign a number depending on what the situation is. For option two, you plant a second crop on the failed acres and waive insurance. Second crop acres need to be reported as insurable when you're doing your acreage report. When the insurance is waived on the second crop, the unit is eligible for 100% of the applicable indemnity on the first crop. This is relatively common when you've got a significant portion of a farm that had damage or the crop failed. For example, if you're farming on the Skunk River and she comes out and takes 40 acres out of 40, that would be a situation where that would apply. Any undamaged acres would go to harvest and be applied to the unit guarantee. So if you had 60 acres of a farm that flooded and 20 were left standing, you take those 20 to harvest, and then any loss would be reduced by the bushels that you were able to harvest there. Losses would be paid after harvest on any of the remaining acres if the insured crop does go to harvest. In option three, you would plant the second crop on failed acres and elect to insure. So the second crop must be reported and production records kept separate from the first insured crop, or from any other acres of the like crop in that farm or unit. First crop indemnity and premium again are going to be reduced to 35% of what they normally would have been. And if there's no loss on the second crop, the company will come back and pay you the remaining 65% on your first crop. For example, if you had insurance on soybeans on the second crop and the corn failed, they're going to come back and pay you the rest of your corn payment at harvest. If there's a loss on the second crop, you've got a choice of the higher of the two losses that will apply there. So, for example, if the remaining 65% of the first crop is higher than the loss on 100% of the second crop payment, then you would have a choice of taking that corn payment over the beans. If the second crop payment is higher than the remaining first crop, then you would take that second crop payment less that additional second crop payment. So these, I've just got a couple of quick flow charts there that are on the back of your handouts. They just kind of take everything that we've just talked about and plug it into a quick little decision aid. And so I won't spend a lot of time going through any of this, but we've got one that's for acres where the first insured crop was planted, and then there's also another where the first insured crop was prevented from planting. So be aware of that if you're looking through any of this information to make sure you're looking at the one that would apply to your situation. So, Anyway, any questions out there? Yes, Dan?
So, we've done it in the past, and I know what the answer is, but, you know, hopefully we get a dry gap in here and we can go ahead and get everything planted. Let's say I want to use a spreader or aerial seed soybeans. Is that covered?
As long as it's considered a good farming practice, yes.
In other words, no.
What do you consider?
I'll be seeing you after class, yeah.
Okay.
Last I knew, incorporation via fertilizer spreader was not considered. Last I was aware, and that's another one, Jessica, if you wouldn't mind write that down, we can look into that. But last I knew, the seed had to be placed in the ground mechanically rather than spread and then incorporated, rolled, whatever the case would be there. Thanks, Dan.
But you consider cover crops. You said if we could get a cover crop in, we should be able to get beans in. Well, I could spread cover crops that way, aerial or broadcast.
Right, and unfortunately, we're not talking about an insurable crop at that point.
Right,
Yeah.
but that disqualifies, I can't do it.
Only during the before final plant date or during the late plant period.
Okay.
Once you get outside of that late plant period, you're okay to do your cover crop.
Okay. I'm rooting for the dry period here anyways.
I think we all are. Anything else? I know I went through that stuff super fast, so certainly don't hesitate to reach out. Give us a call if you've got any additional questions, or if you want to run through a particular individual scenario or anything like that. But otherwise, if there aren't any questions, I think we're pretty well wrapped
I
up.
think we got one.
Oh, yeah.
On the second crop decision of planting, does that affect the choice on whether you take insurance or not on that second crop? Does that make any difference on whether you get the fall price in it or not?
So I think I'm understanding this correct, and if I'm not, just stop me before I get too deep.
I guess
But,
I'll run through the scenario. If I choose not to insure and take my payment and go ahead and plant my second crop, do I lose out
No.
on the fall harvest price option?
For your first insured crop?
Yes.
Yeah, no, you wouldn't. So if you got a preliminary payment, say that was your only corn acres, for example, and the crop was 100% flooded and failed, they would likely, what would happen is federal crop would send you a preliminary payment. And then once harvest wraps around and we get that final harvest price, they'll come back and pay you an additional amount if that price were to go higher. Yes, sir.
Planning date, we have to plan for in this period of time or past that date.
After the final plant date, would you have to plant that?
You know, we're past like 2 months now.
Right. Through today, you have to plant corn if that's what your intention is. For the next approximately 10 days, if we're in a situation where you need to replant, the company is likely going to say, yes, you do need to replant that. However, if your intention was to plant corn, you could technically prevent plant. And you could run that through the entire late plant period. If conditions change enough that you're able to get in the field, maybe Tuesday, you could go in and plant corn, even though you've already claimed preventive plant. It's just going to wipe itself out.
Financially.
I wish I had a good answer for you on that.
I don't think it will.
It would surprise me if it does, but yeah. I could tell you in November.
Okay.
Anybody else? All right, Dan.